Jeff, it's good to see you. And how much worse do you think it's going to get for the oil price and for demand here?
Well, I think it's hard to take a directional view on oil right now, given the fundamental uncertainty. As a result, we just don't like the risk reward for going out there, with the exception of gold, which we're positive on. In terms of thinking about commodities, one thing to keep in mind is that they're spot assets. They have to reflect today's supply and demand fundamentals. In contrast, financial markets are anticipatory assets. They can start to price, once we've hit bottom, they can price the future. Given that with commodities, they're going to be dealing with a surplus. As you pointed out, it's the worst demand shock since 08, 09. They're going to deal with a surplus until at least in the second half of this year, which means we would be a seller of most rallies.
But we do, commodities do have futures markets, and there are ways of looking to see if the curves are, kind of up or down shaped, let's say. What do you see when you look out there? Has most of the damage to the oil price been priced in now, or do people think the price is going to keep dropping?
Well, actually, commodities are the opposite of what you would think about the expectations of forward curves. When the forward curve is upward sloping in a commodity, it means you're building inventory. It means you'd have to buy the commodity today, put it in storage, and you want to have a higher price in the future to pay for that cost of carry. As a result, we look at oil. Yeah, the first two contracts are what we call backwardation on the front end, but as you look out over the curve, the rest of the curve is in a contango, which would indicate that this market is in a surplus when we start to look out 6, 12 months out on the forward curve.
So in other words, it's encouraging people to build inventories right now, and that means going forward, we're going to continue to have more supply than even as that demand is dropping off. All right, so we've hit 43, I think, on the price of oil over the weekend. That's still too high. I mean, what looks economic to you? In the 30s, lower?
Well, in terms of thinking about on a Brent basis, we thought the downside would be somewhere in that 45 to low 40s, which would translate to somewhere in the high 30s on a WTI basis. But I think the key here is that the fundamental uncertainty about this and the extent of the demand damage in the developed markets is still very high. If we think about the outlook for oil, there's three things we're watching: China, ex-China, and OPEC. China, the situation, the worst is probably behind us. We think the total demand hit in China was somewhere around 3.5 million barrels per day. And we're seeing, a reduction in the overall cases. We're seeing restarts in economic activity in China. The problem is now contagion has moved to the developed markets, and we don't know the extent of it, which is why we'd be careful of calling a bottom right here.
So let me ask you about gold before I have to let you go. How high? The all-time high, I think, was around $1,900 several years ago. Are you seeing us go above that level?
Our target is $1,800 an ounce right now. And versus the 1900. One thing to keep in mind, the dollar is near record strength, and when we hit the 1900, the dollar was near record weakness, which tells you just how strong gold is today in the $1,600 an ounce range. Now, there's three things we're watching on gold. The first one is you have a lot of central bank easing. We like to call gold the currency of last resort. And in the current environment, when you have 9 out of 10 of the G10 banks easing, you're going to have a lot of debasement in the currency. Second thing is de-dollarization. Central bank demand from emerging markets remains high. I like to point out central bank demand last year was the highest since the Nixon era, representing 22% of gold supply. We don't see that changing anytime in the near future. The third reason we like gold really has to do with it's the best hedge for geopolitical risk of any sort, particularly the type that we're seeing right now with the virus. So the net of it, that's the one commodity. We have a very strong directional view. We want to be long here. And again, we're trading $1,600 with the upside target of $1,800 an ounce.
All right, so $1,800 for gold and maybe high 30s for WTI?
On Brent, I'm comfortable saying in the 40s. The thing is, when we start to go down, that differential starts to contract. So let's say the low 40s on Brent, and if the differential stays where it is, you're definitely talking in the high 30s on WTI.